Last year, outstanding credit card balances exceeded $1 trillion for the first time. Was it the end of government transfer payments, inflation, are consumers tapped out? If they are, what does that mean for the economy and discretionary spending? We're going to talk about it and take your questions today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe, and welcome to Open Mic, sponsored by OptionPlay. We'll talk about markets, investing, and option strategy, and take your questions. Just a couple reminders, though. If you have a question, please leave them in the chat on YouTube. I don't currently have a mechanism to respond to posts on X, if that's where you happen to be watching. Also, the chat will only be visible during the live stream, and it won't be visible on any replays. Okay, so we got some important economic data today. GDP quarter over quarter annualized was 3.2%. That was lower than the prior period and lower than the 3.3% survey. The core PCE price index also came in at 2.1%. That is slightly higher than the 2% prior survey. Economic growth that is slower than expected and inflation that is higher than expected are not what anyone wants to see. Not consumers, not job hunters, not the Fed, and therefore not those of us who are investors. As I mentioned initially, consumer revolving debt, credit card debt essentially, is nominally at all-time highs. And I think we have a chart here of that. When you look at that chart, there's three lines on it. And what you have here is the nominal revolving debt numbers at the top. The one in the middle is the one that's actually adjusted for inflation. And the lowest one, which is in orange, is adjusted for discretionary income, theoretically. I will point out very quickly that I tend to dismiss that a little bit because consumer surveys suggest that consumers are under considerably more financial stress than that would indicate. So as we discussed on Monday, existing home sales are at multi-decade lows. And we got some mortgage application data released by the Mortgage Bankers Association today, and that helps illustrate that. Applications dropped 5.6%. And the charts that we have, the first one is for existing home purchases, and the second one, which looks very similar and is actually lower, and probably not surprisingly so, is for refinancing. Of course, with most people having rates that are considerably lower than the prevailing rates today, it's not that surprising that there aren't a whole lot of people that are refinancing their mortgages at the moment. The really important economic data that we're going to be getting is the PCE deflator, because the PCE deflator is the Fed's preferred measure of inflation. Obviously, what we saw today is indicative probably of what we're going to be getting, but that's going to be released tomorrow morning at 8:30. And the expectation right now is for 2.4% year over year. And core is supposed to be about 2.8% year over year, respectively. So when we get that data released at 8:30 Eastern time, along with unemployment data and a couple other things, including existing home sales, if those numbers come in hot, I think we can safely expect the futures to be lower. Of course, some of that got baked in already. Okay, so we spoke about lows ahead of earnings. The company ended up reporting EPS of $1.81 a share. That was above the $1.68 consensus with a modest revenue beat. You'll remember that I had mentioned that the company had guided for $86 billion in revenues. The street was expecting $86.160 billion, so modestly higher than the guidance, and I think it came in about another $180 million over that. But the stock did manage to hit a 52-week high before falling off just a little bit. Ended up closing yesterday at 235, but that was still up 1.8% from the prior day. So clearly, I think investors are sort of thinking that maybe the worst might be over there. That has a lot to do with consumer discretionary spending, and we're going to talk a little bit about Target, which is going to be reporting next week. And I want to make sure that I leave plenty of time for questions. But I think this one is going to be kind of interesting. First of all, the street's expecting $2.40 a share for the quarter, $8.33 for the year. That would represent a 36% year-over-year increase, but that's still well below the $13.57 a share that represented peak earnings that they reported for full year 2022. So whenever we're considering looking at an options trade in a stock, I think we kind of need to look at the stock itself. This is a holding of ours and has been for a while. I think the first thing we can just take a look at is a long-term price to sales chart. Price to sales, one of the reasons I like to look at price to sales is because if a company is expecting some volatility in their margins, this is sort of a way that you can kind of smooth that out. So you're just sort of basically thinking that you are going to look at it on a revenue basis. And as we can see, on a price to sales basis, it's well below its peak multiple. Not surprising, as the stock is also trading well below their all-time highs. And then also, if we review their price to earnings, we're going to see that it's also relatively low on that score. And then one other quick point I would say is let's take a look at same-store sales, because I think the same-store sales help us understand one of the reasons why the multiples have been declining. So if your same-store sales are looking pretty grim, that's kind of just a measure of how you're operating as a business. They also had some inventory problems, which I think is part of what was going on. Some may remember that last year there was a bit of controversy around some of their decisions in terms of marketing. There was a boycott. They sort of suffered kind of a Bud Light type thing. I don't think we need to get into that too much, except to say that I think that they're probably moving past that at this point, and some of their inventory overhang had also come in a little bit. So right now the options market is anticipating a move 7% higher or lower by the end of next week after they report earnings. And I think one of the reasons that we can see a move expectation this big is because this is something that has really swung around quite a lot on earnings. So what we're looking at right here is, on these columns, is basically the percentage changes that we've seen after each reported quarter. This is going as I usually like to, from the day prior to when they announced to 3 days after. The idea, I'm just waiting for the 3 days after in my own measurements. People can do this however they like. The reason I like to do that is because sometimes I think there's a knee-jerk reaction. I'm usually interested to find out whether that's all you're getting or whether there is some follow-through, whether it's higher or lower. So once you get rid of sort of the echo or reverberations from that initial response, it sort of gives you a better sense of what's actually going on. And what we can see here is that this thing has had some really substantial moves, and that helps account for the high options premiums going in. And actually, in a second, I'm going to show you how, just on the OptionPlay app, if you happen to have it, because I know a lot of people who are viewing this do use OptionPlay, how you can sort of get a sense of what that looks like. One other quick thing, and we'll go to this next chart here, which I think is also kind of interesting, and that is that, what are we looking at here? So this is basically the returns. All the way over to the left of your screen would be the big declines. All the way over to the right are the big increases. If you were looking at a stock's performance over any normal period and the returns for that stock were normally distributed, what you would expect to have this sort of fill out is something that looks a little bit like a bell curve, sort of a normal distribution. And what we're seeing is that Target is anything but normally distributed when they report earnings. We seem to sometimes live in a narrow band, other times we live in a very big band, and it has some kind of important implications for how we think about using options trading. And the reason I wanted to talk about Target after talking about Lowe's is because Lowe's, it was pretty easy. You could almost do anything on the long side. You could buy a call, you could buy a call spread, you could buy a put, you could buy a put spread. It didn't really matter. The options were cheap, they were very fairly priced, and you wanted to buy them, by the way, going into earnings. And you would likely get a good result. And now I think it's kind of important to sort of address, and I apologize for any of you who think this is a little bit complicated or wonky. If you continue to watch this show in the future, all of these concepts we're going to get into it. I'm not going to get too mathy about it right now. But one thing about trading events with options is that you have to remember that events can really suck vols. And what I'm talking about by suck vols is I'm talking about the decline in something that options traders, insiders, we refer to as implied volatility. Implied volatility is basically the critical input that we use to establish whether how much an option is worth, right? So if a stock is very volatile, as you would expect, the then the options are going to be more expensive. And if the volatility is very low, then they're going to be less expensive. So if we take a look at this next chart, I'm just going to explain what these two things represent. So don't worry about the term volatility. Don't worry about options models and things like that. But what you can look at here is, as we're looking from the left to the right, the left side represents options premiums for near-dated options. So that's the front month options. On average, in the orange line there, that's the premiums for options for the front month just prior to earnings in orange and immediately after reporting earnings in blue. And that is actually, that number would slide down even further if we waited until the end of the day and so on. And as you look further out towards the right, those are longer dated options. So the way to think about this is that options premiums are going to be much higher going into an event than they are coming out of it. And this should make sense in another way. So just intuitively, if we're going to think about it like this, options represent a form of insurance on an underlying stock. Imagine if people could buy insurance for their house on the coast of Florida, and they could buy it for just a month or a quarter. And you'd say, okay, well, how much does it cost to insure my house right on the water during hurricane season versus at some other point of the year? If you know that a period is likely to be more volatile, more dangerous, the insurance premiums are inevitably going to be higher. And as soon as that sort of period of turbulence is behind you, then the premiums are going to be substantially lower. So this is kind of the same thing that we're looking at here. And I bring this up because what I observed when I was taking a look at target options prices going into earnings was that there was almost no sort of really simple structure that demonstrated over the course of history that it had any kind of consistent outperformance. And of course, you can come up with convoluted structures that might accomplish this. But I wanted to kind of help people understand the dynamics of why sometimes it can be very easy to justify buying a call going into earnings if you're bullish, buying a put if you're bearish, and other times it's a much more complicated exercise. So let's now just take a look actually at the OptionPlay application. I'm just going to bring this up, and again, I know that a lot of you use this, and the reason I'm going to do this is because it's a fairly easy way to illustrate it. So first things first, I was talking about the implied move. Now, I know that a lot of you are very familiar with this concept, but for those of you who aren't, what options prices can tell us, among other things, are how great the expectations for volatility over a certain period of time might be. And so one way we can actually figure that out is we can just take a look at the value of the at-the-money straddle for, this is sort of a simple way. There's a more complicated mathy way, but it isn't really important to get into that. Just take a look at the at-the-money straddle that expires, for example, in 1 week. So next week, Target's going to be reporting earnings. They're going to be reporting on Tuesday, March 5th. So we can actually go in here and we can say, okay, well, why don't we just take a look at the first expiration date that follows that event? That expiration is going to be March 5th. And so we're going to take a look at the at-the-money straddle. At-the-money simply is referring to strikes that are very close to where the stock is currently trading, which is 151.5. So we're going to pick something fairly close to that. A straddle is simply combining a call and a put of the same strike and same expiration. So for anybody who's unfamiliar, I'm sure most of you are, but I just want to make sure that we can sort of be inclusive, if you will. So I'm just going to quickly, it doesn't really matter. I'm using some mid-market prices. I'm just going to assume we buy both. So let's see here, 151.5, I guess 152.5. That's the closest at the money strike we have. So I'm going to choose the 152.5s. So 152.5 call, 152.5 put. We can blow this up. You buy the call, you buy the put, you get a payoff that looks a little bit like this shape. If it moves violently higher, you can make profits. If it moves violently lower, you can make profits. But the important point in terms of establishing what the implied move is is to simply take a look at what the cost of that straddle is. And when you add that together, that's going to give you the implied move. And I must have done something wrong in here because I know for sure with a high volatility stock like this, let's see, I'm just going to refresh this in case I did some, I've been playing around with this on the side, so experimenting with a couple things. So you will forgive me. All right, there we go. Let's go here. Whoops, March 8th. I'm sorry. That's the one we want. March 1st doesn't capture earnings. March 8th captures earnings. That's where I went wrong. Okay. So again, we're just going to combine the first expiration that captures the event. Look out to the end of that week. I'm looking at the at-the-money call. At the money being the strike that's closest to the current stock price, 151.5. Closest strike is 152.5. So I'm looking at the 152.5 call, the 152.5 put, adding those two things together, and here's what we get. Now you will notice the cost of this option, this trade, $1,130. So that's $11.30 per share. Remember that almost always stock options are going to represent, except in cases where there's corporate actions that can adjust the share count. But by and large, when you're dealing with stock options, you're dealing with contracts that represent 100 shares each on the underlying. So what we can see is that's $11.30 higher or lower. You can divide 1130 by 151.5, and that gives you approximately your implied move. So about 7.5%. Okay. So the difficulty we end up with, if you're trying to use options into an event like this, where you sometimes have big moves, sometimes have very small ones, and you've got a move of 20%, so you can't really use ratio trades and things like that. You get into a situation like this one where finding a trade that expires on that target date, buying the call, if you buy that thing, it has not historically turned out very well if you bought it at a price like this. Same thing on the put side. I will say, though, that things you can do to mitigate this, if you're bullish or bearish, is to use a spread and think a little bit about that implied move that we just discussed. So the implied move is 11.5%-ish. Okay, so why don't we just call it, we'll call it $10 just to keep the math really simple. So that straddle's actually 11. But what I could do is I could say, all right, well, maybe I'm going to buy a call spread that expires at the end of that week that goes up that implied move to the upside. So if the stock moves the amount that the options market is anticipating, and that's an on average number, and it moves that much to the upside, I could, instead of just simply buying the at-the-money call, I could instead buy a 152.5 call and then sell a higher strike 162.5 call against it, just using mid to mid prices. And so always, when you're executing trades like this, try to, especially if the bid-ask spread is wide, you want to try to use limit orders and get as close as you can to the mid. Start usually at the mid if you're using, a limit order, and then walk your way up. If you're buying, walk your way down. If you're selling, rather than just throwing in market orders or hitting bids and lifting offers. Okay, so what we find now is that I'm actually going to be spending $3.34 a share, 100 share multiplier. That gets me to $334 if I make this upside bet. So now I'm actually mitigating considerably the amount that I'm spending. So now spending about $3.30, round numbers, on $150 stock. So we're talking about a little over 2%. So now actually I'm improving my odds if I'm making a bullish bet, because the stock doesn't have to rise as much for me to see profits in this case. Now, for those who are interested in taking on more risk and want to reduce the cost still further, one of the things you could do is say, okay, well, and assuming that you have cash available in your account to do this, because when you start selling options outright, The margin requirement is certainly going to be higher. But something else one could consider would be selling a downside put as well. This is a trade called a call spread risk reversal. Again, let's remember what we thought the implied move was, 10, 11 bucks. We're at 151. So let's look down to, say, the 140s. I can sell that to help finance this as well. That gives me a payout profile that looks a little bit more like this. Just a quick point, though. Obviously, this increases your maximum risk considerably because you could be compelled to purchase the underlying shares at the strike of the put that you sold. That's $140 a share. That's obviously a decent discount to the 151.5 where the stock is currently trading. But that may not necessarily be a risk that you like very much. I will say something else, which is that in general, this is just sort of a general rule of thumb that I have. You can take it or leave it. I don't really like selling uncovered options for less than 1% of the notional value of the stock. It's just not something I happen to like to do. You can annualize those returns and they look very good. I'll give you an example. If I sell a downside put that expires next week, and for the sake of argument, it costs 75 cents. So I'm selling a downside put for 75 cents. It's $150 stock. One way to think about that is to say, oh, well, I'm getting 75 cents a week on a $150 stock. If I annualize that return, it comes out to a very nice number. I'm going to be getting 25, 26% a year annualized. That's the way some people like to think about it. I'm not that crazy about that approach. There's a lot of path dependency, and when you start selling insurance into events when things can move in a really volatile way, which we know that Target can, as we've seen, then this is probably something that you don't want to do. Some of you may be comfortable if you're thinking about buying the stock anyway. It does sort of improve your odds in a couple ways, but it's just not a really attractive trade from my perspective. Okay, so with that in mind, I am hoping that we can take a few questions, and I apologize. I'm going to try to take these things in order, and I'm also going to try to be quicker than I have been. I think I was not particularly quick on Monday when I wasn't doing it. Okay. Well, here's a question. I think this is kind of interesting. This goes to the earlier part of what we were talking about. Isn't delinquency more important? And I think he's referring than the revolving debt levels. And so the short version is that in terms of indicating the strain on consumers, I would say yes. Because if you start seeing delinquencies rise, then that definitely indicates that there is some stress. And to that point, we should note that auto loan delinquencies have indeed been rising. And the reason I'm actually highlighting auto loan delinquencies instead of revolving credit card, revolving debt delinquencies, is because consumers have to be under considerable duress before they get to a point where they're not paying their car loan. Most people don't want to lose their car. They might depend on it to get to work. They depend on it to get their kids to and from school, whatever. It's not the kind of thing, people are going to probably default and become delinquent on their revolving debt more quickly than they will on an auto loan. But we have seen rising auto loan delinquencies. So when you factor in higher revolving debt, you factor in higher auto loan delinquencies, you factor in the fact that we see lower consumer cash balances on average in their accounts, you put those things together, and to me at least, that's not really it's not a really pretty picture. I think consumers are under some strain here. We really need to see, people always talk about inflation rates coming down. That's fine. A lower rate of inflation is obviously better than a high rate of inflation, but inflation is still inflation. That means prices are still rising. We need to see inflation get to a manageable level, and I don't think we're quite there yet. All right. Next one. Okay, what are the three most important fundamental metrics when analyzing a stock? PE, so price to earnings, free cash flow, or earnings per share. Okay, so I care a lot about all of these things, and let's just touch on it kind of quickly. First of all, price to earnings. The way I think about price to earnings is I am interested in price to earnings to growth. So, for example, Kroger's, which is the grocery store that a lot of you might be familiar with, that's a stock I have owned on and off in a number of times in the past because I've just been fascinated by the fact that it's a staples company. They seem to operate okay. They're not going anywhere. And the last I was looking, I don't have it in my book right now, it was trading around 10 times earnings. So 10 times earnings seems extremely cheap, but of course their earnings aren't growing. And in fact, if it's trading at 10 times earnings, so you're getting a corporate earnings yield of 10%. So that's the way to think about that. If I buy a stock for $100 a share and it's making $10 in earnings per share per annum, that's a PE of 10. If I invert that relationship, so 10 divided by 100 is 10%, that's my corporate earnings yield. So when I start thinking about how much is my investment making me, that's one way to look at it. Now, if the earnings continue to grow, then getting 10% and having growing earnings is phenomenal. But if earnings are kind of trending down and trending down fast, then 10% corporate earnings yield is a lot less attractive. And if it just stays static, I'm always going to get $10 a share, then essentially what I'm getting is a bond, right? And then I have to discount the value of that by a couple of things, which is, basically what the risk-free rate is, but also I have to incorporate things like inflation. If we're seeing 10% year-on-year inflation, the value of that $10 a share in earnings per share 10 years from now is going to be a fraction of what it is today. So that's one thing that matters, and that's one of the reasons I kind of like to look at the PEG ratio. That's the price earnings to growth. So that's one important thing. Free cash flow is much more important right now than it was 3 years ago. Why is that? Because the cost of capital for businesses is substantially higher. 3 years ago, companies could borrow money essentially for nothing. Many of them did. Many of them did that to buy back their own shares, and that was a great thing for shareholders. Apple could issue long-term debt. They could pay virtually nothing for it. They had tons of free cash flow. They didn't need to issue the debt, but they could issue debt. They could basically borrow money for nothing, and they could use that and their free cash flow, which they generate a ton of, to buy back shares. And of course, that creates real support for the other shareholders, because of course the share count is going down, so your pro rata percentage ownership in the company keeps going up. So essentially your EPS is going up, all else equal, for as long as the share count's going down. So I think that's very important as well. So free cash flow is more important to me now than it was 3 years ago. So I definitely look at that. It's one of the reasons why, think about Alphabet. There's a company that just got taken out to the woodshed this week, but it has tremendous free cash flow. I mean, they've got a big lawsuit on their hands. People are concerned about ad spend trends and things like that. But free cash flow matters a lot to me. The higher rates are, the more it matters. Okay. All right, so here's a question, because this is what's coming tomorrow. So can you explain what a high PCE means and a low PCE means? So PCE, this is basically the Fed's preferred measure of inflation. So everybody's probably familiar with CPI, the Consumer Price Index. PCE, which is the personal consumption expenditures, it's actually called the PCE deflator. But basically, there's the PCE deflator and then there's core. So they sort of, whenever they're talking about inflation, there's usually a basket of things that they think about, and some things they like to exclude for this reason or another. Oftentimes they'll exclude things like energy because it's too volatile, or sometimes housing because it's too volatile. I mean, to me, that's just ridiculous, because oftentimes they end up excluding things because they're volatile, but they're really a huge portion of what people are spending their money on. So you're not really doing anybody any favors by measuring inflation if you're only looking things that aren't volatile, because it's exactly price volatility that creates the problem in the first place. If you go to the grocery store and a gallon of milk costs you $5 one day, and you go back 3 weeks later and it's 10, that's really going to shake a consumer. And if you decide, oh, we're not going to count that, it's too volatile, we're not going to count it, I just think that's ridiculous. But anyway, PCE is the Fed's preferred measure of inflation. So the reason we care about it is because when they're talking about getting to 2% inflation, that's what they're talking about. I don't think we're going to see it fall below 2 anytime soon, because inflation just tends to be a little bit stickier. And it also tends to move, in my experience, in waves. Inflation drives prices higher. Labor demands higher wages. Wages, can create their own measure of inflation and so on. Okay, so here's another question. Hi, Mike. How do you compare the EPS forward to the current trading price to determine if the stock is at a premium or a reasonable discount? Okay, so the forward EPS is, well, first of all, we don't know what earnings will be. We estimate what earnings will be, or we can take other people's estimates of what earnings will be. And this actually goes to my earlier comment about price earnings to growth, which is that I know what the trailing 12-month earnings are, and I can see what the street's estimates are, and I can see some estimated rate of growth between the two, or lack of growth, as the case may be. Professor Schiller at Yale, he one of the things he likes to look at as well, and I think this is important too, he likes to look at an adjusted PE that he calls the CAPE ratio. And what that does is it looks way back in time. So he basically goes back 10 years. The idea being that earnings from quarter to quarter, from year to year, could be volatile. And he's just trying to use that to smooth it out. I like to look at going back a couple of years and just sort of observe the trend. Are we basically seeing earnings growing on trend, and is the forecast for that earnings consistent? Also important is that price to sales metric, because if I see earnings going up consistently, but top line revenues are not, why is that? So the company is not growing at the top line, but earnings per share are going up. Well, a couple of things could do that. You could see better operating margins. And that's important. You have companies actually that have growing top line and growing margins. NVIDIA raised their prices. They had 20-something% margins before a big price increase. They're obviously growing the top line by incredible amounts. The most recent quarter was 265% annualized growth. But they had also increased prices, so their margins went from mid-20s to mid-50s. So you could see EPS go for that reason. So is EPS growth a function of top line growth? And by the way, it's important to me to see top line growth growing at least the rate of nominal GDP growth. So nominal GDP growth is GDP growth without adjusting for inflation. And the reason I don't want the inflation adjusted number is because if you're looking at the way companies don't inflation adjust their revenues. So if you go on to the investor relations website, you take their financial statements, you go through time, if they did 10 billion last year and they did 9 billion the year before, and they did 8 billion the year before, so they're growing at 1 billion. By the way, that indicates that the growth rate would be slowing, right? So those are the kinds of things I look at. What else could raise EPS when revenue is not growing? Well, what I just talked about before, which is stock buybacks, of course, right? So if the share count's declining and the revenues are staying the same and net income is staying the same, but again, the share price is declining, then EPS will rise. So I think it's important to factor in all of these things. Am I buying a company that's growing? Am I buying shares whose EPS is growing? Am I getting both? Why is it? One other really important thing about margins to me is that you have very low margin businesses, Amazon, Walmart, Target. These are very low margin businesses. Procter & Gamble, arguably. And low margin businesses, in theory, could expand those margins if they get some form of competitive advantage. But immensely high margin businesses, you can never make more money than you collect in revenues, right? So if you have businesses like NVIDIA that have 55% net margins, you're getting pretty close to, could they expand further? I guess, but don't count on it. Okay, so let's see what else we have here. Somebody just said 7.5%. I assume they're talking about the implied move. Here we are. Okay, I heard the strategies which involve selling options are, quote, better, unquote. than those which involve buying options because, and I assume, I don't see the rest of this, but I'm assuming that the rest of this simply says, oh yeah, because the majority of options expire worthless. Is that true? Okay. So yes, it is true that most options expire worthless. But here's a reason why that might be. Imagine you have a stock that's $100 and I could buy a 100 strike call in $5 increments going up so that I can buy the right to buy the stock at higher prices, or I could buy the right to sell the stock at lower ones. By definition, at some future point in time, on some future expiration date, the price of that stock can only be one number. The stock cannot simultaneously go from 100 to 110 and simultaneously be at 90. It's either at 110 or it's at 90 or it's at 100. It's added. There's a discrete moment in time and the stock must be at that price at that time. Therefore, if a stock went from 100 to 110, every single put strike below 110 is out of the money. So those all are going to expire worthless. And of course, by definition, every call strike above 110 is also out of the money. So those all expire worthless. So when you think about it, by definition, even if you could buy options for nothing, which would be an arbitrage, you can't lose. Someone just handed you options for nothing. Still, at least half of them would have to expire worthless. Does that mean that they're overpriced when you buy them? No, it absolutely, certainly does not mean that. Not at all. Okay, so how do we sort of think about it? So this goes to the question that I was referring to before. How volatile is the underlying stock? If it is highly volatile, then the value of buying insurance, and calls and puts are both forms of insurance. I could own stock, I could buy a put to insure my downside, or alternatively, I could not buy the stock. I could just buy an at-the-money call, and that's synthetically the same thing. I have upside but no downside. If I could get those options for free, obviously it's a great deal. If I can get them anywhere close to free on anything that's volatile, then I'm obviously getting them at substantially below their value, their theoretical value. So the truth is that when it comes to selling options, you want to sell options where you believe that the premiums represent an attractive rate of return for selling insurance on the underlying asset to somebody else, because that is what you are doing. And that can be consistent. And the reason this is important is because a lot of times people go what I call premium hunting. They say, oh, well, most options expire worthless, so I should sell them. Okay, well, there's some logic to that, but I just pointed out why that's a little bit illusory. So if selling premium is good, then selling very high premiums is even better. So they'll go hunting for stocks that have really high options premiums. They'll go to Carvana. They'll say, well, Carvana's options premiums are incredible. I can, the straddle is 20% of the stock price. Is that a good way to think about things? Well, no, because Carvana, the equity is a small portion of the company's value. The debt is a much bigger piece. And that's true for a lot of these very volatile companies. The really volatile stocks will tend to have a lot of things in common. They have very volatile operating results. Oftentimes they have considerable amounts of debt on their balance sheet. Many times that debt is of a speculative grade, not investment grade. Speculative grade debt is debt by any of the major credit rating agencies that they believe there's a good chance it's not going to be repaid. And so insuring the equity, of course, is going to cost you a lot of money. And being the seller of that insurance isn't necessarily the best thing to do. So what you ought to be doing if you're thinking about selling premium is first identifying underlying assets that you feel comfortable insuring, because that's what you're doing. You're selling insurance. Whether you own the stock and you're selling an upside call, or you're selling a cash covered put, or you're selling calls and puts, you don't want that underlying asset to be too volatile, and you need to understand it. If you are selling downside puts on the equity of a stock who is experiencing operating difficulties so significant that they're very likely to default, so you find that their debt's trading 60 cents on the dollar, you have become the first loser in the event that that company goes under. The first thing to go is equity, so if you've sold insurance on the equity, you're the first one to go. So selling it on Procter & Gamble, while not as exciting, not as great in terms of yield, and Procter & Gamble does have some debt, but it's a very stable business. That's a better idea. Look at Berkshire Hathaway. Berkshire Hathaway has has a lower volatility than the S&P 500. Why is that? It's because they've got $167 billion in cash, according to their earnings, which they announced last Saturday. When is the best time to place, here we are. When is the best time to place this order? Just before earnings, Jay Bayo asks. I assume this is in reference to Target. And we are actually talking about the trade going into earnings. So we're long a call spread into earnings to make a bullish bet rather than buying the stock, which is up over 40%, I think, off the October lows or whatever. So that the trade that I was using as an example there would be, a less risky way to bet on the stock making a positive move out of earnings than, say, selling downside puts or something like that. Okay, let's see here. This is interesting. I noticed on my Thinkorswim platform that theta for long call three-leg butterflies positions bounce around significantly, up to 80% compared to a long call vertical position. Any insights? Okay, so I don't personally use the Thinkorswim platform, so I don't know exactly what they're doing there, but couple things to think about. Okay, so for those of you who don't know what theta is decay. So every single day that you own an option, as you get closer and closer to expiration, it's going to give up some of its also known as time value or its extrinsic value. So with butterflies, this is really interesting. Okay, so if I put on a spread, and maybe what I should do is illustrate what a butterfly spread is for somebody who doesn't know, because there probably will be people who are not familiar with what a butterfly is. So very simply, when you trade a butterfly, and it doesn't matter whether you trade a put fly, call fly, what some people will call an iron fly, basically what you're doing is you are buying one option, selling two of another option, and then buying one on the other side. I probably should have used a wider one than this. This is probably a little bit hard to read because I'm only going a week. Let's do this. Let's just pick a wider fly. Make it a little easier to actually make this out. Okay, doesn't really matter. I'm gonna actually make it a short fly. We can look at this either way. Okay. So why does your rate of decay change? The reason is it has to do with whether you are outside of the strikes or between the strikes, whether time is on your side. So when you look at a payout chart like this one, so everywhere it's green, I'm going to make money. Where it's red, I'm going to lose money. I lose the most money at this spot here. So in this example, I'm selling the wings and I'm buying the middle of it. And I can actually flip that around. And I can do the opposite. So now I'm buying the wings and I'm short the meat of the fly, the middle strike. Well, the reason your theta is changing is because imagine that I'm outside of these strikes right now. And I've got, in this case, until June before this package expires. Well, if the stock stays right here, as time passes, I'm losing money because I'm out of the money in this trade. And so every day as time passes, I'm giving away a little bit of its value. On the other hand, if the stock price is right in the middle, every single day I'm gaining a little bit more of its value. So the reason you're seeing volatility when your trading application, your trading software, your broker application is reporting the net theta to you is because you are running back and forth between your strikes. It doesn't matter whether you're long or short strikes. If I'm long these strikes, my theta is going to go from negative to positive as I migrate from below the call strike that is out of the money or above the call strike on the high side. So that's what's going to end up happening. If you are in a position that sees its maximum value where you are right now at expiration, you are going to be in a position that has a positive theta, a positive rate of decay. Time is your ally. If you are away from the area where your trade is most profitable, you are actually going to be paying it away over time. So I hope that helps you. So that's one of the reasons, when you trade these multi-leg spreads, you think you're getting into a position that pays you, and maybe it is paying you when you get in, but as it migrates away, suddenly it doesn't work. And it's interesting because a debit call spread, so I buy it out of the money call and I sell a higher one, I need the stock to go higher. If it sits here, I'm paying away each day. But if it runs up to that higher strike, it's not going to maximize the value of the spread right away. Now time has become my ally. So that's one of the things that I think is important to keep track of. Hi, Mike. How would you size an NDX put spread to cover a $100,000 stock portfolio? Would you buy the equivalent amount of options that translates roughly to holding 100,000 of stock or something else? Okay. Well, yeah. So the way you're thinking about that is correct. Did I send that, by the way? I don't know if everybody can see that. Let me just make sure that it got out there. Okay. The thing is, NDX is a big contract, right? So just to put things in perspective, I use a lot of SPX options because my portfolio is probably more closely represented by the S&P 500 index. One SPX options contract has a notional value of about $500,000. And that's because it has a multiplier of 100, so we're just going to use round numbers. S&P's at 5,000, so I buy a 5,000 strike put. It has a multiplier of 100. That means I buy one put, I'm insuring $500,000 notionally of S&P exposure. NDX is a big contract. So if you're going to insure a $100,000 stock portfolio, you're probably going to be using a smaller contract size than the NDX index options would be. You could use something like QQQ, right? So QQQ is the NASDAQ 100 ETF, the ETF that represents the NASDAQ 100. QQQ, you're going to have a 100 multiplier, so you're going to get to a notional size that makes more sense in that context. Can we ask questions on Twitter? Yeah, so anybody who joined late, I don't have any mechanism to see that here or respond to them. So I apologize for that. Thank you very much if you're watching on Twitter/X for watching, but I actually need to get that information from the YouTube chat for now. We're going to try to work on that. Okay, it looks like we have already been going now for about 45 minutes. So I like to try to take as many questions as I can. I hope I'm punching through them a little more quickly than I did the first time I tried this. I promise you I will get better. If you like this kind of content, please like, subscribe, come back when we do the next show. We're doing these on Mondays and Wednesdays at 4:15 Eastern Time. And we have an affiliate link for OptionPlay below. So I really appreciate you guys watching and bearing with me as I try to figure out this live streaming thing. But I definitely enjoy interacting with everybody, and so I really appreciate the questions, and I will make every effort to answer as many of them as I can. Thanks for watching.